What if I told you there's a simple strategy that could potentially double your charitable giving capacity while cutting your tax bill at the very same time? Most generous Christians that I meet, they want to give more, but they feel constrained by their current cash flow, or they're frustrated by the tax bite of selling appreciated investments. My name is Coley Anida. I'm a certified financial planner and a certified kingdom advisor with John Moore Associates, and today I want to introduce you to one of the most powerful giving strategies available, donor-advised funds. Our team has helped numerous clients implement this exact strategy, and in some cases, we've seen families increase their charitable giving by 50% or more while significantly reducing their tax burden. Now, before you think this is some complex strategy exclusive for the hyper-wealthy, let me assure you that donor-advised funds can be incredibly beneficial for anyone with appreciated assets, whether that's stocks, bonds, mutual funds, real estate, or even business interests. Today, I'm going to walk you through exactly how donor-advised funds work, show you the step-by-step process on setting one up, and give you real-life examples on how this strategy can transform your giving. Okay, let's start with the first most important thing. What is a donor-advised fund? Well, a donor-advised fund is, in and of itself, a nonprofit, but you can think of it as a charitable checking account. The way I look at it is it's a conduit between you and the end nonprofit that you want to support. The way it works is you give assets, this could be cash, stock, bonds, you name it, to the donor advised fund, and you get an immediate tax deduction in the year of the gift. Now, these funds can be invested and grown tax-free while you decide where you would like to give those dollars. Now, there are some key advantages over direct cash giving to charities. Number one is you get to pick when you get the deduction, even if you're doing your giving over multiple years, and we'll talk about how that works. You get investment growth, which multiplies your capacity for giving. You're able to give anonymously. So if you don't want the recognition or you just don't want the mailers, you can do that with a donor advised fund. And it also simplifies your record keeping. If you're giving to more than one nonprofit, you will just have one tax receipt to deal with come April. So the second thing I want to cover is what should you give to a donor advised fund? Well, here at JMA, we have a saying that says, never write another check. We can't stand it when our clients give cash. Now, there's some instances where you have to give cash. Think about the Arizona tax credit program. You have to give cash. There's no other way. But in most cases, giving cash is the least efficient way to do your charitable giving. When you give cash, you're leaving money on the table in the form of capital gains tax that you're paying that you don't need to, or income taxes that you're not getting a deduction on. So you're paying that capital gains tax before you're giving to charity, and then you may not actually be giving enough to get an income tax deduction. These are big problems when it comes to tax efficient financial planning. But even worse than that, worse than the tax impact on you and your family, is that ultimately this oftentimes will lead to a charity receiving a lesser gift because you have to first account for the tax treatment of the dollars that you're giving. So we always recommend, if possible, give appreciated assets, particularly long-term appreciated assets, assets you've held for greater than 1 year that are at a long-term capital gain. Here's the beauty of this scenario. You can give those long-term appreciated assets. You can get a full fair market deduction in most cases for those assets, and you don't have to pay the capital gains tax that you would have had you sold the assets in the first place. So what does this mean? This means that the charity gets the full value of the asset that you're giving. You get the maximum tax deduction, and you get to avoid the capital gains tax. So let's walk through how this works in a real world example. Say you bought $10,000 worth of stock 20 years ago. Today, it's worth $100,000. What you could do is you could say, hey, I'd like to make a big gift to my church. I have $100,000 of stock sitting in my account. Well, what you could do, and what you might think of doing, is you could sell that $100,000 worth of stock. You could realize $90,000 of long-term capital gains, which would result in around $18,000 of tax liability, which leaves $82,000 of cash available to give to your church, and only results in an $82,000 charitable deduction on your tax return. So let's flip that, and if you were to have given the stock whether it be to a donor advised fund or to your church, you would have been able to give the full $100,000 of stock. You would have paid no capital gains tax, and you would have gotten a $100,000 deduction on your income tax. The charity gets more, the government gets less, and you get a larger deduction. It's win-win and lose for the government. Donating directly before you sell saves the tax and gets more dollars to the end charity, exactly where you want the dollars to go. This helps you maximize your deduction, and it helps you limit your capital gains. Now, there are a few things to keep in mind here. When you're giving appreciated assets to a donor advised fund, you can only deduct up to 30% of your adjusted gross income, or your AGI, on an annual basis. However, if you end up with a larger gift than you're able to deduct for, you are able to carry forward those deductions for up to 5 years. So as long as you're intentional about using up that deduction over that 5-year period, not all is lost when a gift is too big for 1 year's worth of deductions. It's also important to realize that that AGI limit of 30% is actually less than the limit if you were to give cash. So in a year where you really wanted to maximize how much you could deduct, it could make sense to make a cash gift as opposed to gifting assets, because there's a higher limit. Up to 60% can be deducted when you're gifting cash. But the beautiful thing about it is a donor advised fund can accept cash or appreciated assets. It doesn't matter. It just depends on your own unique financial situation. So the third thing I want to cover is, when do we give to a donor advised fund? I mentioned at the beginning that you're able to pick and choose when you want to get your deduction. So this is perfect for when you want to accelerate a deduction for a year where you have uneven or lumpy income, or you get a big windfall event. Think if you're in the sales industry and you're going to have a big commission, maybe you're going to hit that bonus incentive, maybe you're getting some stock options that are exercising, or restricted stock units that are vesting, where it's going to really boost your income for the year. Perhaps you have a liquidity event on the horizon. You're going to sell some real estate or some business interests. Those would be great times to do large gifts into your donor advised fund. But it's important, when you can, give before you sell. Very important here, and talk to your tax attorney on this. Make sure you give before you enter into a written agreement to sell anything. That's very important. You want to make sure you give well in advance of any sale, because this is where the real magic is. You get to avoid the capital gains. And if we are doing the strategy that we're talking about right now, where we are bunching multiple years into a single year of deductions, this becomes extra important. In 2025, the standard deduction for a married filing jointly couple is $31,500. Now, we serve a lot of generous clients that don't quite give enough to itemize for their charitable giving every year. So if they're giving cash and they're only giving $15,000 a year, and they have no other deductions, no mortgage interest or anything like that, they don't even get a tax benefit of a deduction for a gift. And if they're giving cash, then they're not even avoiding the capital gain. So there's really no tax incentive or benefit for charitable giving. Enter bunching. Bunching is the strategy where you get to pick and choose when you want to take your deduction, and you can front end load future giving in a particular calendar year. So say you are one of those income earners that you hit that bonus, you got that commission, you're going to have the liquidity event in this calendar year. You could say, I am going to accelerate my giving. I'm going to give that big chunk of stock, that percentage of my business, part of my real estate, into a donor advised fund. I'm going to receive that large tax deduction for whatever the fair market value of that gift was. And then I'm going to spread out my giving over the next 2, 5, 10, 20, even 30 years, as long as you would like, but you get the deduction in the year that you need it. And then you get to determine where, when, and how much those grants are over the coming years. Another benefit here is if you front end load the donor advised fund and you get that large deduction in the year where you need it, a high income year, you can then invest those dollars and earn tax-free returns, multiplying your capacity to give down the road. These truly are incredible vehicles. Now, before we dive into some other real examples and exactly how it works to open up one of these donor-advised funds, I want to mention that while donor-advised funds are powerful tools, they're just one piece of a comprehensive giving strategy. At John Moore Associates, we help Christian families all over the country integrate their charitable goals with their overall financial plan, which includes tax planning, estate planning, as well as investment management. We typically work with families who have over $500,000 to invest and want to align their giving and their financial plan with their biblical principles. Our approach starts with understanding your heart for generosity. Then we build strategies that maximize your impact. If you'd like to explore how a donor-advised fund might fit into your giving strategy, click the first link in the description below to visit johnmoore.com and learn more about our process. Okay, before we can get into the strategies, we have to talk about how do you set one of these up. Well, first, you have to choose your sponsoring organization. You can choose a big national provider like Fidelity or Vanguard or Schwab. They all have their own donor-advised funds. Likely your community has a community foundation. I know here locally we have the Arizona Community Foundation and they do an exceptional job. Or you can choose a faith-based option that aligns with your Christian values. Our personal favorite, where most of our clients have their donor-advised funds, is National Christian Foundation. They've been around for decades and they do an incredible job supporting us and our clients in their generosity efforts. Some of these organizations will have initial contribution requirements. It could be a couple $1,000, it could be $20,000, but there can be initial deposit requirements. NCF doesn't have those. One of the reasons we love them. Most of these can be opened up online and you can select your account setup and investment options. It's very simple and easy on most of these platforms. You can choose how the dollars will be invested, from cash all the way up to aggressive growth strategies. Our suggestion is similar to a financial plan. You want to make sure that the investment selection sticks with your risk tolerance and is in alignment with your time horizon on when you want those dollars available to make that gift. But that is all part of a comprehensive giving plan. You also want to make sure that you set up successor advisors. This is similar to a beneficiary on a regular account. However, the dollars don't go to them. The dollars go to them in order to give to charity. So it stays in the fund, but they're the next one in line if something happens to you on who can grant out of that donor advised fund. And then you want to start making some grants. Start picking out qualified nonprofits to grant out to. Now, each one of these donor advised funds will have different stipulations on which type of nonprofits you can grant to. Every one of them has slightly different rules, so make sure that you are aware that these dollars can be declined depending on the organization you're trying to support. And then finally, a lot of these providers will have some kind of research tool online to help you with your charity selection, and we love that. And oftentimes, one of our favorite things about NCF is that they have people that you can pick up the phone and you can talk to them about charities. You can help with getting the grants made. You can talk to tax attorneys about the more complicated things. They have all the resources available. So if this sounds like a commercial for NCF, it kind of is. We love them over there. Go check them out. We'll have the link below in this as well. So now, finally, I think what you've come for is some real world examples on how we've seen giving capacity increase using this tool of the donor advised fund. So the first case I want to look at is an executive that had highly concentrated, highly appreciated stock in their particular company through equity compensation over the last decade or more. Now, this particular client had over $1 million in company stock with essentially zero basis. And in this particular tax year, they were getting a fresh tranche of RSUs, or restricted stock units, that were going to vest. This was going to push their taxable income up dramatically. They were going to wind up in the top tax bracket that year, somewhere they'd never been before. Now, they expressed that they'd like to give $20,000 per year, and they plan to do that at least for the next 10 years until they retire. Well, at that pace, $20,000 per year, they're unlikely to get an income tax deduction because they just don't have enough deductions to get above that standard deduction. So we said, you'd like to give $20,000 per year for the next 10 years. What if this year, in your highest income tax year of your lifetime, we gave $200,000 of the highly appreciated, highly concentrated company stock that you own into a donor advised fund. We can sell it, diversify, and we can sprinkle out the $20,000 per year gifts over the next 10 years. And given decent market performance, we should end up with more than $200,000 going out of the donor advised fund over that 10-year period. All the while, you'll get a $200,000 deduction in the year of the gift. How would that sound, Mr. and Mrs. Client? Of course, that sounded amazing. They got to avoid $200,000 worth of highly appreciated stock that they would have sold somewhere along the line. They got to fuel their generosity. They got the largest tax deduction they've ever gotten. In fact, they wound up with a carry forward on their tax deduction. And they pre-funded their giving for the next decade. This ends up freeing up cash flow over the next decade because they've already pre-funded their giving. They can still reach their giving goal through that entire 10-year period. And they get tax-free growth within the donor advised fund. Incredibly powerful tool. And this is a level of giving that they had never even dreamt of. Had they instead sold the stock, this would have realized roughly $40,000 in capital gains tax. Remember, they had zero basis and they wanted to give away $200,000. If they would have sold all that stock, that would have been roughly $40,000 of capital gains. That means they only would have had $160,000 left over after they paid their tax bill to give to charity, which would have resulted in $40,000 less of a tax deduction. All across the board, they would have wound up in a lesser financial position. With the tax-free growth on this account, just invested conservatively, they wound up with over $250,000 in that account that went out. That means they funded over 12 and a half years of giving in their donor advised fund with only the contribution worth 10 years. This is wise stewardship. This is multiplying your generosity. This is taking your one talent and multiplying it in the form of generosity, utilizing the tools available in a wise way. This is something that God smiles on. These tools are available for everybody. Why shouldn't we use them to multiply kingdom impact? Now, of course, it doesn't always work out this way. If you invest those dollars, they can go down. But if you have a long enough time horizon, it is generally prudent to take that risk as long as you're comfortable with it. Okay, let's look at another real world example on how this worked out. So we had a business owner. This business owner sold his business for $100 million. $100 million, big time money. What he did, he was wise enough to connect with NCF before he sold, before he entered into the sale agreement. And what did he do? He gave away 30% of his business. He gave 30% of the outstanding shares to National Christian Foundation. They held on as a shareholder for his business. And then upon sale, about a year later, 30% of the proceeds of the sale went to National Christian Foundation. So why did that benefit him so much? It's because he was able to take a 30% deduction on his AGI, his adjusted gross income, in the year of the sale, because he made the gift early in the year and then he sold late in the year. He was able to give it away. He didn't have to realize the gain. He had started this business with zero. There was zero cost basis to the business. He sold for $100 million. That means it's all taxed at capital gains. He got to avoid $30 million worth of capital gains. The tax liability on $30 million on capital gains is millions and millions of dollars. And he got that out ahead of time. So he avoided the capital gains and he also got the deduction for $30 million. Now, these are round numbers. Not everybody's situation is going to work out the same. And I know we don't all have $100 million businesses to sell, but the principles remain. Giving before you sell is better than giving after you sell. Giving appreciated assets is typically much better than giving away cash. Never, ever write another check if you can help it. These strategies work for the $100 million client or the $100,000 client. So now let's talk about some common mistakes to avoid and best practices. First, don't rush on the grant making process. Take your time. There's no rush. Of course, we want to get the dollars out to the end charity. We don't want them sitting in the donor advised fund for long, but take your time, do your research, go take a tour, take a visit, really figure out where you want to make an impact. And do they need the money now? Do they want it sprinkled over time? Would that help with their accounting and their cash flow? Make sure you're not too big of a giver where they become reliant upon you. That can really hamstring a nonprofit over the long term. So get to know the organizations that you give to. Also, consider those multi-year commitments. Spread it out. Maybe it's a pledge for a building project that's going to be over a couple of years. Maybe it's to help a particular program run for multiple years. Instead of a big $100,000 gift all at once, maybe they would prefer some $20,000 gifts over 5 years instead. So consider those multi-year commitments, and the only way you can do that is if you get to know the nonprofit. Don't just get online and send the money over. Talk to somebody, especially as those dollar amounts start to creep up. And one of our favorite things is getting your family members involved in the grant making decision process. Make generosity part of your family values. Make it part of your routine. Do your giving as a family. Perhaps this looks like having each family member nominate a particular nonprofit. One of my favorite stories is getting each kid to create some kind of presentation, almost like Shark Tank, on why the family should give their extra gift, their sacrificial gift, to a particular nonprofit. And each year they pick one of the kids' nonprofits to give the bulk to. They'll say, we've got $1,000 we're going to give. The winner gets $800 and the other two get $100. It's a great way to make giving part of your financial conversations as a family. Be very thoughtful about the timing of your contributions as well as the timing of the grants. You want to make sure that you're picking the right tax years for the contributions, and then you want to make sure that you're cognizant. There could be matching grants available at particular times of year. I think of Phoenix Children's Hospital here in the Valley, where every November there's a match from the city of Phoenix. So making grants during November multiplies your generosity again. And then finally, consider your entire overall financial plan. This includes your giving strategy, but that of course includes your tax planning. It can include your estate planning. So having someone like a JMA advisor in your corner to coordinate that entire financial picture can be hugely valuable, because this can be a little bit complicated to manage on your own. And while we've talked about investing, and you want to make sure that you pick the correct investments based on your risk tolerance and your time horizon, sometimes cash is the right thing there, because in reality, in most cases, we're trying to get the money out of the donor advised funds. That's the biggest mistake I see with donor advised funds, is people get the tax benefit and they make the gift to the donor advised fund, and then they don't actually go in to grant it out with any sense of urgency. So while you don't want to rush a grant, you also don't want it to sit there doing nothing. Get the dollars into the hands of people that are doing kingdom work. Now, donor advised funds can be one of the most flexible and tax efficient giving strategies available today, and they are not just for the super wealthy. Whether you have appreciated stock, a windfall of income in a particular year, or simply want to be more strategic about your charitable giving, a donor advised fund can help you give more while paying less in taxes. The heart behind generous giving matters the most, but being wise about how we give allows us to give even greater kingdom impact with the resources that God has entrusted to us. At John Moore Associates, we've seen families transform their giving through strategic planning, and we'd love to help you explore whether a donor advised fund makes sense for your situation or not. Visit johnmoore.com or click the link in the description to schedule a complimentary consultation where we can discuss your giving goals and how to optimize your charitable impact. Remember, it's not just about giving less to the government, it's about giving more to the causes you care about while being a wise steward of your resources. Thank you so much for watching, and if this was helpful, please subscribe to our channel for more content like this, and I'll see you in the next video.